If you had $10,000 in your bank account in 1967, it would have lost 66% of its value by 1982. Oil prices went from $3 a barrel in 1970 to $30 a barrel in 1982. The median price of a home in the United States in 1970 was $22,000. By 1980, it had tripled to $66,000. This is not fiction. This is something that actually happened, and the reality is it could happen again. Home prices have already surged from $320,000 to $420,000 since 2020. The US dollar has yet again lost almost 20% of its purchasing power just over the last 3 years, and that's a result of the largest spike in inflation since the 1970s. In fact, many economists have already suggested that inflation is following a similar path to the 1970s. And of course, we do see some similarities in the way that inflation is behaving. We saw 3 waves of inflation in the United States in the 1970s, progressively larger and larger, which you could extrapolate to today and say that we're still due for another massive wave of inflation. And we've already just seen 2 consecutive positive readings showing that inflation is once again moving higher since the month of June. Oil prices have already climbed by nearly 40% since June. The price of sugar has almost tripled since 2020, and just since June of this year, it is already up 20%. The price of live cattle has more than doubled since 2020, and since the beginning of this year, it is already up by 21%. All of that leading to inflation peaking at 9% in June of 2022, and now the inflation rate turning back up again since June of 2023. If we decompose what has actually driven this inflation rate since 2020, the biggest contributor is without a doubt energy. Not because it's the largest component of the CPI. You can see, for example, the services component in black here is a much larger contributor to the inflation rate, but it's very stable and slow moving. If you look at the energy component in blue, you can see it's a lot more volatile. The energy component in 2020 was contributing negatively to inflation. If you remember back here, oil prices plummeted down to $0 per barrel at one point during the pandemic. Now, of course, the price of gas at the pump wasn't $0, but energy inflation was still declining rapidly, and within just a few months, that turned into a positive contribution for inflation in 2022. And actually fueled the entire first part of the move up in inflation. And in 2022, it has once again been negatively contributing to inflation. This is a chart of the volatility of inflation components. So that red line right here is called motor fuel. It's the price of gas at the pump, and it's by far the most volatile component of inflation. But hang on to your hats, because we also use oil for pretty much everything else we do in life. You want to eat an avocado? Well, you're going to need to get that delivered to you straight from Mexico by a boat. Higher oil prices means higher cost of transportations, which means a more expensive avocado. So transportation, plastics, cosmetics, electricity, these all have an oil component in them. If you simply put the price of oil against the inflation rate, they pretty much look the same because of that sheer volatility and all the impact that oil actually has on inflation. So if we want to know if there's going to be another wave of inflation, we have to look at oil. If oil prices continue rising substantially from here, it's going to drag inflation up with it. One of the things that could actually do that would be another oil shock, a little bit like what we saw in the 1970s. In 1973, Arab oil-producing countries like Saudi Arabia and Kuwait decided to stop shipping oil to the United States. Oil prices surged overnight from $3 a barrel to $10 a barrel, setting off a massive wave of inflation where it actually reached 12% in 1974. Just for some context, that would be the equivalent of oil's price jumping from $90 jumping to $280 per barrel next week. Of course, that would be incredibly inflationary and would guarantee that we actually see another wave of inflation. Now, just last week, Saudi Arabia and Russia announced that they are cutting oil supply again. Now, with oil's price jumping by 40% since June, you could be wondering whether we are actually in the early innings of an oil supply shock that is similar to what we saw in the 1970s. Fortunately, that doesn't seem to be very likely. The United States has ramped up its oil production over the last 15 years, pretty much doubling it since 2009. Since 2018, the United States is now the biggest oil producer in the world. That means if there's another oil shortage, the US can just produce more oil to make up for that type of supply shock. This is actually what we saw in 2022 during the Russian invasion of Ukraine. US oil production picked up during that supply shock, limiting the damage. And in fact, since July of 2023, we've seen oil production pick up quite significantly here as oil prices have been rising and you've had some concerns around supply cuts. By the way, this big drop here was during the pandemic where oil prices were at $0 or almost at $0. So there was absolutely no incentive for oil producers in the US to actually produce oil. So while supply was a huge driver of oil's price between 1970 and 2021, you can see that blue part shows how much supply is driving oil's price versus how much demand is driving oil's price in red. But if we just focus on the period between 1996 and 2021, so basically the period where the United States has become a major oil producer, demand has been much more important than supply. So demand is what ultimately determines where oil is going next. Now, the problem for oil demand is the possibility of a recession. Odds of a recession predicted by the yield curve are currently at the highest level in 40 years. Every time the probability has gone above 40%, we've systematically seen a recession every single time, the only exception being 1967. You can probably guess that demand for oil isn't going to be very elevated if the biggest consumer of oil is actually heading into an economic contraction. At the same time, we've just seen the largest drawdown in fiscal expenditure of the last decade in the United States. You remember those big stimulus packages that saved the economy from collapsing during the COVID pandemic? Well, we're now seeing the mirror image of that. So what used to be $2 trillion in excess savings that we had in 2021 is now completely run out. So the helicopter money is gone. It leaves us with the economy that we had before the pandemic. The majority of the population in the US have actually seen their share of national income decline over the last 40 years, which we argue does leave the economy more vulnerable today than perhaps the economy we had 50 years ago, where income and wealth inequality were incredibly low. But in 2007, oil actually rose substantially, heading into the worst downturn since the Great Depression. In 2007, the Federal Reserve stopped hiking rates, they paused monetary policy, that put a bottom in oil prices, and then they actually began to cut rates. Speculators saw this and started to turn very optimistic on the future of the economy, bidding up oil prices. At the same time, you had a lot of speculation around China that was growing very quickly at the time, and their share of oil demand was growing too. So oil actually went from $60 a barrel in 2007 to $120, doubling in price right before the global financial crisis. So the 2007-2008 melt-up in oil prices is proof that you can have a melt-up in oil without real fundamentals and heading into a downturn. So that's a scenario we can't exclude for today if we see a speculative move in oil prices, and that could actually contribute to a lot of inflation. Of course, if this were to happen, it would completely crush the consumer that is already struggling today and likely could precipitate a recession like it did in 2008. But could we avoid a recession altogether? Remember, the government has the ability to avoid a downturn by injecting fiscal stimulus in the economy like it did during COVID. If we see fiscal government spending pick back up to support the economy and the central bank begins to lower interest rates in an effort to avoid a recession, well, in that case, the US economy could actually end up avoiding a recession altogether, head into another period of strong economic growth. Now, in that case, demand for oil would pick back up sustainably enough to lead to another large move up in energy prices and inevitably leading inflation much higher over the long run. That's the no landing scenario. Now the question is that something we should expect the government and central banks to do, effectively risking seeing inflation pick back up significantly? Looking forward in the next decade, we are entering an era where there are notably higher risks of seeing large swings in economic volatility and high risks of seeing inflation volatility. Knowing where to find opportunities in this type of environment will separate people who benefit from this environment from those who get hurt by it. That is exactly what our mission is at gameoftrades.net, to help you find those opportunities.